Hi traders, Alan Virtue here. I'd like to welcome you personally to Virtue Trading and wish you the very best of good fortune on your trading journey. As a member of VT, you now have access to all of our trading tools and educational materials, and I'm sure you will find them extremely useful in your quest to achieve financial independence. There is one trading tool, however, that we cannot provide. In fact, it's not really a tool, but rather a character trait. It's something that must be developed from within. Strong emotional discipline is something that can't be taught. Learning to control emotions can really only be accomplished through experience. It's essential that you understand its importance, however, and find a way to develop and strengthen it. Of course, we can guide you and provide material support, but ultimately it is you and your reactions to the twin emotions of fear and greed that will ultimately decide the degree of your success or failure. This applies equally to those who are mirroring our trading signals with the profit guard or the javelin, as it does for those who are entering the market positions manually. Becoming a trader requires you to overcome your anxieties, your fears, and emotional ill discipline. Nothing in life is free, least of all learning how to profit from the forex markets. We as traders have absolutely no control over market forces. We are subject to periods of extreme volatility, which often have a negative impact on our account balance and our self-confidence. Understand, though, that we need market volatility in order to capitalize on price movement. Without it, the market would stagnate and the potential to profit would be severely limited. Volatility cannot, however, be guaranteed to always produce positive results. In fact, what can be guaranteed is that very often it will not produce positive results. There will occur periods of account drawdown. There is nothing surer, it's a trading fact of life. If you're not prepared to accept this fact, then you should probably just invest your money with a managed fund so that you can't see what's happening to it on a daily basis. Remember that the same volatility is occurring for all market participants, not just you. This includes investment funds. Now just think back to the fun and excitement you had around the time of the global financial crisis, when you received your annual superannuation statement and just discovered you'd lost 40% of your investment. The big difference between trading your own money as opposed to letting a hedge fund do it is that with a fund you don't see the ugly bumps in the equity curve. At the end of the financial year, all you see is a beautiful straight line from 0% when you started to maybe 6% return if you're lucky at the end of the year. And you didn't sweat a bit. Why? Because you were unaware of what was happening in the market. You were blissfully ignorant. When you trade your own money, however, you always know what's happening. In fact, that's your edge. Now, it can at times be unnerving, but always knowing your current account status is the advantage you gain as opposed to blindly leaving your capital to the discretion of managed funds. Now, as an educator, one of my greatest challenges is explaining to new, inexperienced traders why, in order to be successful, they must take a long-term view. Get it out of your mind now that you're going to be rich by this time next week. Trust me, it ain't going to happen. Trading requires a deep understanding of your own psychology, and that, in my experience, can take some time to acquire. In most pursuits of life, there is a good deal of predictability. Nothing in life is entirely risk-free, but most things we do are relatively controllable. Trading for a living is a totally different kettle of fish. Here you're dealing with hundreds of thousands of market participants, all with varying degrees of emotional attachment to their money. Take my word, you won't be immune to these powerful market drivers, and it's why I emphasize the importance of developing emotional self-discipline. When trading Forex, our current risk and reward perspective must shift from an expectation of certainty to one of probability. If it can be demonstrated that historically the strategies you employ are profitable, then it's probable that they will continue to be profitable. But it's not guaranteed, and there will always be losing periods amongst the winners. An equity curve charts or plots in a similar fashion to price charts themselves. In them, there's no such thing as a straight line. There will always be highs and lows. However, as long as the general direction is heading north, we shouldn't be concerned when at times it turns the other way. Provided we stick to our plan, the laws of probability suggest it will return to profitability in the future. Of course, if we stopped trading altogether, there is no possible way to recover any losses. It's a classic conundrum. The act of trading is really quite simple, but that doesn't make it easy. Let me try and illustrate my point. Note this equity curve of one of our systems, the FXO system. Here we're looking at an approximate 2-month period. Now, it doesn't look too good, does it? It's probably not a strategy you'd be interested in, particularly if you just started trading at about here. Now let's look at the same system over a 2-year period. How a change of perspective can also change the result. Down here you can see that the drawdown we looked at in the last slide was simply a minor pullback from the general equity uptrend. Now let's say you had started trading the strategy at these points and it immediately went into drawdown. What would you do? Give up and stop trading? If you did, your losses would be permanent. Worse still, when you looked at what could have been the value of your investment if you'd continued to trade, you'd see that instead of losing, you'd be sitting on a pile of money. Now, we've all experienced that sick, empty sensation you get when you realize you've blown your chance at achieving something meaningful. Welcome to trading. Here's an equity curve of another of our systems, the Javelin. Same thing. How many would have thrown in the towel here, or here, or here, or here? Many would have stopped and condemned themselves to failure only to find some months later that their disciplined and educated co-trader, who understands how markets work, had kept trading and cleaned up big time as a result. Do you see what I'm getting at? Why you must develop psychological strength. That can only occur if you understand how markets operate and how trading relies on the laws of probability. If your strategy has shown good return over the longer term, then it stands to reason it has a very good chance of continuing to function with similar profitability. And if it does start to misfire because of an extended change in market conditions, then the strategy can be re-optimized to suit. But trying to change it every couple of weeks is self-defeating. If you do that, you don't have a trading plan. And if you don't have a plan, you're doomed to failure. Please understand that all of our systems are continually monitored. And if we deem changes should be made, then retesting is conducted and the strategies are realigned with current conditions. Before I finish up, I'd like to acquaint you with a couple of well-known traders. Both of these traders have won the Robbins World Cup of Trading, a prestigious award made famous by legendary commodities trader Larry Williams, who over a 12-month period turned a $10,000 account into $1 million. Now, I don't have examples of Larry's equity curves here, but I do have those of one of his students, Andrea Unger, an Italian trader who became the first trader to ever win the World Cup 3 years in succession. In 2008, Andrea garnered a staggering 672% return on his investment. As I show you these curves, take note of the drawdown periods, both the number and the size. Did he give up during those losing periods? If he had, nobody would know how much he'd missed out on, including himself. Look at these charts. These are very ugly equity curves, and yet this man not only won the 2008, 2009 and 2010 World Cups, but gained returns of 672%, 115% and 240% each year respectively. There's a really great interview with Andrea on Vimeo at the URL on your screen. I highly recommend it. Please note though that Andrea Unger is not associated with Virtue Trading in any way, but his interview is freely available on the internet and much of his trading philosophy mirrors our own here at VT. Another trader, Kevin Davey, who was actually a student of Andrea, also won the Robbins World Cup of Trading. Now check out the drawdown periods in Kevin's equity. Would you be able to withstand drops of up to 49% in your account? No? Well, I think I'd find it difficult too. And you can be assured that we at VT would be re-evaluating our strategies well before equity started hitting those sorts of numbers. In fact, we have protocols in place that alert our traders to any major changes in the efficacy of our systems, so that we can suspend trading if and when adverse conditions occur. We teach you how to protect your own account in a similar fashion. Now, you probably can't read Kevin's notes on this chart, but essentially the blue line here is his backtesting results and the magenta line is his live trading. Each of the drawdown periods he highlights represents losses of more than $10,000. However, as you can see, his account continued to grow. He's tacked his live results onto the end of the backtest, and at the time of producing his chart, he was $8,000 in the red. He asks the question, would you quit knowing the system has recovered 4 times in the past from $10,000 drawdowns? Well, would you? I'll leave you with a slide that hopefully won't offend you, but which I believe sums up the need to build endurance into your trading psyche. I wish you good trading and the very best of luck. We hope that you enjoy your stay with Virtue Trading and your dreams are realized. Remember, in trading, patience is a virtue.